Good day and welcome to Sterling Tools Limited Q1FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Group CFO, Mr. Pankaj Gupta. Thank you, and over to you, sir.
Thank you very much. Good morning, everyone. On behalf of STL Group, I extend a very warm welcome to our Q1 and FY24 earnings call. Today, I'm joined on this call by Mr. Atul Agarwal, our whole-time director, Mr. Jaideep Wadhwa, our director, and SGA, our IR advisors. We have uploaded our result presentation on the exchanges, and I hope everyone had a chance to go through the same. I will now request Mr. Atul Agarwal for his opening remarks.
Good morning, everybody. Welcome again to our quarterly investor call. Good to connect with you all over again. I look forward to a healthy interaction. I'm not going to get into too much detail on numbers. You guys do this day in, day out. But let me give you a highlight of what's happening in the auto industry. The industry has grown by about 2.8%. With all segments put together, wherein passenger vehicles showed a growth of about 7%. Three-wheelers had a growth of about 24%. Two-wheelers grew at a marginal growth rate of 1.3%, and CVs were negative. Commercial vehicles were negative by 3%. Obviously, there are individual companies who have done better than the others, but I'm just trying to give you a flavor as to what the auto industry looks like. So Q1 was not as strong as we had hoped it to be from an industry perspective. Having said that, despite the auto industry only growing by about 3% overall, we were up about 7% in revenues, just to give you a flavor of that. EV segment grew up by almost 60%. If you factor in certain other kinds of vehicles, almost up 77% in volume terms. So the EV story is still looking strong. There are some concerns around FAME too, but I think the industry is absorbing that impact, and the market leaders and the stronger companies will come out ahead stronger in that process. Our revenue of EV component business from 37 crores to 74 crores of Q1 FY23 and Q1 FY24, so we are up 100% in revenue. And I think the bottom line numbers, Pankaj will get into that detail with you, but even our bottom line numbers have stabilized, have grown. I think we are showing an EBITDA margin of 9% in the first quarter. In our fastener vertical, we were up 7% in revenue. Not as per our expectations, but we are still hopeful of maintaining our guidance for double-digit growth next year or this financial year. Normally, first quarter is always muted as a percentage of our total revenue for the full year, and we are on track to achieve that numbers. It's looking tougher, but I think we have some good initiatives in the pipeline where we hope to achieve double-digit growth on that. I'm going to hand over to Pankaj to talk in more detail about financial data, and then we'll open the room for questions. Thank you.
Thank you, sir. I'll give a brief financial highlight on the Q1 FY24. I'll start with the standalone numbers. For Q1 FY24, the total income increased from 138 crores to 148.6 crores. That's a 7.5% YOY growth. EBITDA stood at 21 crores, which is pretty much in line with previous year. The margin is 14.1%. PBT stood at 11 crores, that is about 7.5%, and profit after tax for this quarter was 8 crores. Coming to the consolidated financials, the total income increased from 175 crores to 22 crores, and that's about 27.6% growth. EBITDA increased by 22% to 28 crores, and YOY our margin stood at 12.4% on console level. PBT increased by 31% to 16.9 crores in quarter one, and PBT margin was 7.6%. We have seen a very robust growth in our PBT on our PAT, both on YOY and Q1Q basis. As for the quarter, has increased by 36.2% YOY and 68% quarter over quarter, 13.1 crore. So those are a few highlights, and thank you everyone. We can now begin question and answer session, please.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may press star and one to ask a question at this time. We have the first question from the line of Deepan Shankara Narayanan from Trendlyne PMS. Please go ahead.
Good morning, everyone. Thanks a lot for the opportunity, and congratulations for great set of numbers. So, firstly, on the EV business side, so what is the contribution of top 1, 2, 3 customers, and has it improved substantially quarter on quarter?
Customers as of today are Ola, Ampere, and Torque, which is a part of the Kalyani Group, and the other, and you know, and I'll also add, though you asked for 3, I'll also add 4, which is the sales through SEG, which go to a number of customers as they sell our motor control units along with several, along with their motors to several customers. The percentage has been about stable across these 4 over the last quarter.
Okay. And so these EV two-wheeler volumes has fallen in July month, but top 3 players have been increasing their market share. So how has been our order book progressing there, and what kind of EV revenues we are looking for FY24?
So I think so. I mean, yes, it is true that there has been obviously a setback in the industry due to the changes in the FAME policy. Some companies have weathered the storm better than others. We are fortunate that some of our customers are amongst the companies that have done better and have managed to maintain volume. So our order book is healthy. I think that we look at our current run rate, and it's a run rate that we can maintain and possibly enhance.
Okay. And EV business, what is the reason for a sharp improvement in gross margin Q1Q, and is it sustainable margin for us for the coming quarters also?
Yeah, so we have, I mean, you know, compared to last year, obviously there's a steep world of change that we have been through. We have localized much more. As we've got volumes, we've negotiated better pricing with our suppliers, both for imported components as well as for local components. So there's a lot of improvement that's been done over this year. I mean, it's 12 months, but it feels like 24 or 36 months in terms of, you know, what all has happened during this period. In terms of the margins, we have consistently maintained that in the short term, we believe that this business is an 8 to 10% EBITDA margin business, and that's where and that's what we expect. There may be minor changes within a quarter basis, product mix or other factors, but 8 to 10% is where we expect to be, probably closer to 8 than to 10.
Okay. And any progress on this MCU LCV product launch? Have you tied up with any large customer?
Yeah, so we actually have very good success with our LCV customers. We think we have a very strong market share there on the LCV customers. As you know, the data is all out there for you to see. The product launches by our customers haven't taken place. So while our products have been used in the vehicles that have been sent for homologation, while we continue to supply samples for proto builds and the initial trials, we won't see the volumes. You won't see this reflected in our numbers until our customers actually start selling this in the market, which we are hoping will be, I think the third quarter of this fiscal is when we'll actually start to see some traction on that. At least one more quarter of the same type of activity where we'll be doing a lot of technical work, we'll be doing a lot of engineering support work. Our customers will build vehicles, get feedback, get homologation, etc., but it won't translate into numbers. Once our customers launch, then obviously we'll see the numbers kick in.
Okay. Thanks a lot and all the best.
Thanks.
Thank you. The next question is from the line of Viraj from SIMPL. Please go ahead.
Yeah, am I audible? Hello?
Yes, sir, you're audible.
Yeah, so thanks for the opportunity. Just three questions. First is on the fastener business. I think, when we talked last quarter, we were expecting a very strong commencement of new order pipeline. So our expectation were more of healthy double-digit growth, even in an environment where the market may not grow or be flat. So we were expecting a lot of programs to commercialize. So any update you can provide? Has that been delayed and hence we are seeing, relatively a muted growth, or the expectation itself is now, if at all it has changed? Any perspective on that?
So, actually, when we did the outlook for this financial year for the industry was very good. CV industry had done very well last year, and it is expected that commercial vehicle business in FY24 will be stronger than FY23. Having said that, first quarter of FY24, CV industry has been negative. So it has been a double whammy in a perspective. Instead of no growth, there's also a negative growth in that segment. Tractor industry, which has gained about 10-12% of our revenue, is down 11% as a segment. So these two negative growths in the industry have impacted our growth numbers. So programs are still alive, but the volumes we were expected for those programs to come through have not crystallized, which is putting pressure on the growth numbers. Yes, you're right. I think our guidance was much stronger in my last call with you guys. But I think the first quarter industry performance has not been as expected. It has been disappointing, which is putting pressure on our growth. But we are still up 7%. And I think knowing what's happening to the industry and knowing what's happening to some of our competition, we believe we could do better. Yes, I think we are still in an okay space, and we still have 3 quarters yet to go. We are hoping that the commercial vehicle industry will turn around because that's still the largest consumer of automotive components in India. I think that's what my response would be.
Okay. And second question is largely in terms of the operating margins in the fastener business. So one is the contribution margins, and if we see, say, year on year as well, we've seen some moderation in contribution margins. So how should one understand? I understand there's a numerator effect, but is there any other element either in terms of product mix or the new business we have kind of bid at maybe a slightly aggressive quotes? So is that the reason why the contribution margins may be on the slightly lower side? And in the journey to sort of 16 to 19%, is it more largely driven by scale, or you see recovery in contribution margin itself being a major driver?
So last full year, on an annualized basis, we had a margin of 15% plus on EBITDA. The concern was margins coming in Q4-23. But I think if you look at our Q1 margins, we have improved our margin positions over Q4 quarter of 23. So it's an improving trajectory. Yes, there is a numerator-denominator effect. Our guidance has been about 16% for this year. So I think the way things are going and the growth we have and in cost saving and improvement initiatives we have in our operations, we believe we'll be close to 15% plus operating margin numbers on a full year basis. So they will definitely, I think the concern is this flag was raised for our Q4 margin numbers being a little depressed vis-a-vis other quarters. There were various reasons which I explained earlier, but I think we are recovering ground from our Q4 margins. They're already improved, and we hope to continue to improve that. So I don't see that as much of a concern going forward.
Okay, but there's no change in terms of the base margin with which we do the business, any new business we bid for. There's no change in any of those parameters.
No, none. I think we are still acquiring new businesses. Margin retention and margin visibility is always one of our key decisions, our key guiding principles when we acquire new business.
Okay. Last question, if I can, is on the EV business. Correct me, what I understand is the portfolio customer concentration is very high currently. So the top customer may be 60, 70 or even higher in terms of share of sales. And in the last quarter, we talked about looking at potentially 350 crores kind of a scale this year and further build up on that. So in terms of the customer mix or the portfolio mix, how are you looking at in 24 and 25? What will drive that?
So I think, and I think I partially answered that in the earlier question. I believe that our customer profile and our ratio of customers or our ratio of sales to the top customers will remain relatively unchanged for this fiscal year. As we go forward into next year, I do expect to see a significant change as more customer programs come online and gain volume. What has happened is that, as you're aware, with the change of policies on FAME, there has been setbacks. I won't call them anything else. Setbacks or delays in the launches of other vehicles and the volumes picking up. And our volumes with these customers obviously depend on what they produce and actually sell in the market. So we continue to be the sole nominee for these businesses in most cases. We are waiting for the volumes to pick up. We are our customer mix.
Okay, I'll come back in soon. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and one. We'll take the next question from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, government has issued quality norms for the nuts, bolts and fasteners to curb the import of substandard goods and boost the domestic manufacturing. So how this will be positive for your company?
So the government is coming out with the QCO, like you said, but this is impacting this. So let me give you how the industry works currently. Government wants to introduce a BIS system for fasteners, but the challenge is all our customers, and in the passenger vehicle space, The Japanese and Koreans dominate that space with almost a 70%, 75% market share. And they work as per the Japanese standards. Or within the Japanese standards, Suzuki will have their own Suzuki engineering standard. Toyota will have their own. Honda will have their own, and same thing with the Koreans as well. So none of the fasteners are made to any particular standard product lines. They're made as per spec for each drawing, and all these drawings are specific to that particular function and following certain OEM standards who are consuming them. Suzuki, Honda, Toyota, or Hyundai for that matter. Same thing applies to Tata and Mahindra. Tata and Mahindra have their own Tata standards, and Mahindra will have their own standards. So government is trying to bring in a common standard across the board, but the functionality and the specifications are totally different. We are working closely with the government and with Automotive Component Manufacturers Association and our key.
Ladies and gentlemen, the line for the management has been disconnected. Kindly stay connected while we try to reconnect the management. Thank you. Ladies and gentlemen, thank you for your patience. The line for the management has been connected. Over to you, sir.
Yeah, thank you. So the QCO, we are working closely with the government. We're working with the automotive, which is ACMA, ACMA, and we are working with the customers at the same time. So it's a work in progress. I think I'm sure we'll arrive at a workable solution. But having said that, whatever the solution is arrived at, it's not going to impact our business negatively or positively. We just have to align ourselves with the market needs and address those issues. So from a pure, from a business sustainability and a growth perspective, I don't think it has any impact on that.
Okay, sir. And in a fastener business, your growth was 7% Y-on-Y. So how much volume growth and how much the impact of the fall in the realization because of the fall in metal prices?
So our volume growth is about 5%. So our volume goes about 5%. So there is no. So steel prices, like I said, have stabilized. All that has been factored in. So our volume and price points are pretty much aligned. There may be a differential coming of 1 or 2% over time, depending on the product mix for that quarter, or some customers buying different kind of products. So that mismatch, which was there in the last 2 years for volume and value, is probably aligning itself now.
And how was the mix standard versus the special fastener in this quarter, sir?
Same mix, yeah, pretty much the same. It doesn't change very much quarter to quarter. We can talk about on an annual basis. On a quarter to quarter basis, the mix does not change very much.
And sir, your margin has in a fastener business that has gone up by the 200 bits quarter on quarter, but still it is at a lower side. And last quarter you had mentioned that you are facing some problem because of the increase in the conversion cost. So can we expect that this problem will be sorted out in the coming quarter and will be able to get a margin of 16-18%, what you are targeting for the medium term?
So if you see, like you said yourself, that our margins have improved quarter over Q4 to Q1 this year. We are already in the process. We are working with our customers. We are trying to get some price increases on conversions, which some have kicked in, some will kick in as and when the negotiations crystallize. At the same time, we are looking at cost improvement activities in our operations. It's a combination of host of things to bring back our margin numbers to more to the more expected levels where we want to be.
So margin is
Trend is already improving. Only one quarter has gone by. We hope to maintain this going forward.
So in this quarter, as you mentioned that there was a lower growth from the CVs and the tractor. So is it also impacted your margin in this quarter because the mix is slightly poor?
No, it's not really impacted in that sense of the word. It's like I said, one quarter is too tight or too short a period to have meaningful impacts. I think these take a few quarters of numbers to work through, but we don't feel that the lack of growth in CV or tractors has impacted us as of now.
Okay, sir. And my last question on that, in MCU business, you are targeting around 340 to 350 crores kind of the revenue in FY24. So are you still intact with this number?
So, we've closed the first quarter at 73 crores, and then there's also other income of about a crore, so let's say 74 crores. We believe that run rate, despite the hiccups, is maintainable, and we have the opportunity of increasing that further. That's where we look at right now, current basis, what the current estimates are. There's possibly upside that we will see coming in the latter quarters as more programs come online.
So when can we expect the volumes from the LCVs and passenger vehicle in MCU segment?
So LCVs should start by the third quarter of this year, as I had mentioned. I think they'll at least start up by then. I hope that starting next year you'll see many more LCVs on the roads, and that will be very good for us. Passenger vehicles will probably be a little further away.
Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Alisha Mahawla from Envision Capital. Please go ahead.
Hi, sir. Good morning. Opportunity. So I just wanted to know, have you signed the agreement with GTEC? Are the terms frozen now?
So the terms are frozen. We are going to China next week to finalize this.
Okay. And we were talking of increasing the MCU capacity. Where are we on that? And other plans of increasing it further? Have we signed any new customers or clients in the last one quarter?
So, in terms of our capacity, we've talked about being able. We've mentioned that we'll be expanding our capacity to 600,000 units. Now, I believe some of our investors had visited our plant, so the construction is underway. Once the construction is completed, we'll be able to get to that 600,000 annual volume. In the interim, we've been able to, within the existing facility, by doing some debottlenecking, we are able to increase over 400,000. So we've made a step improvement, but in the capacity, a step enhancement in the capacity. But obviously, there is the full effectiveness of this will only come into play once we have the extra space that is required. To answer your second question, I think it's addressed in our investor deck. We were at 14 confirmed contracts in the last quarter. We are now at 16. And both those, just as a piece of additional information, both those customers are in the LCV space.
And of the 16, how many of your products are live? Because you did see that you're expecting a good amount to start in Q3, especially for the LCV clients. So of these, is it possible to understand how many clients are live?
Ma'am, the management's line has been disconnected. Kindly stay connected while we try to reconnect them.
Yes.
Ladies and gentlemen, thank you for your patience. The management line has been reconnected. Miss Mahavla, you were asking some question, ma'am. Please continue.
So I got the question. I was answering it. You had asked the question as to how many of the 16 customer programs that we have been awarded are actually which are already in production. About half.
Okay. And the balance you're expecting most of them to go live in the second half of this year, or there's still going to be a large part of it which will be launching the products only in 25?
No. I mean, we expect all of the balance to go live this year. I'll have to say that it depends a little bit on the customer, but I would be surprised if any one of these don't go live within this fiscal year.
Got it. And just one last question on the fasteners piece. We did mention in our opening comments that CV was kind of weak and that has impacted our growth, but we're still expecting growth to continue to be in double digits. So are we gaining market share, or are we hoping the other segments to kind of pick up? And also on the margins, we should talk of 17-18%, so significantly lower. What will be the driver for margins in this segment? And will we hit that number this year or next year?
So to address the first part of the question, yes. So we have not lost any business in the CV segment. In fact, we have acquired new business both at Leyland and at Daimler. So there are no concerns on losing our share of wallet or share of business with the customers. Just an overall downtrend. Leyland and Tata have suffered substantially in the first quarter. Leyland had a booming Q4 last year, but I think it's a combination of sales issues and inventory correction that they have done in Q1 this year. So there is no concern of that. Going back on margins, I think let me just say that we are improving. We are on track to do 15% this year. We have improved our margin in Q1 over Q4 last year. But at peak level, our margin used to be 18-19%. I think if you do a like-to-like comparison, I can request SGA to set up a separate call to run through a number in detail because steel prices have gone up. We have got a full compensation on steel prices from our customers through and through. There may be a lag of a quarter max, but we have been compensated fully for that steel price piece. What we have not been compensated fully by our customers has been conversion costs going up, which is the value addition we do. Typically, our raw material content before price increase used to be about 37%. It's gone up to about 41, 42 now. And that's a function that prices have gone up, but we have not been able to successfully get increases on other inflationary issues of power and energy, chemicals, oils, tool steels, etc., etc. So it's a combination of those two things. We have got some increases, but from some customers, which is helping us bump up margins again. But from a pure mathematical basis, that 18% benchmark what we had earlier is coming down to 15% on a like-to-like basis. Like I said, it's a mathematical equation. I'll request SGA to set up a call with you independently, and maybe Pankaj can run that through with you. So when we look at the business overall, our concern is getting conversion cost increases from customers because of inflationary pressures. Steel has been fully compensated. Having said that, despite those pressures, we are doing well through cost improvement programs internally and product mix improvements with the customers.
Ms. Mahavla, do you have any further questions, ma'am?
Hello, am I audible?
Yes, ma'am.
Just a clarification, sir. Are we saying that in the current scenario, a more sustainable number for this business is about 15%?
I would say between 15 and 16%. That's correct.
Got it. Thank you.
Thank you. We'll take the next question from the line of Viraj from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity again. Just a couple of questions on the EV business. First is, we talked about moving the capacity from, say, 3 lakh units to 6 lakhs. So now with the increase in expansion, is there now a further plan in terms of further localization? Or we think that the level with which we are is good enough at the moment? So any perspective you can give in terms of the milestones we will look at for further localization? And a related question is on the agreement with the tech partner. So will there be any further payout, either in terms of royalty, or how would the arrangement work?
I think in a second.
Hello?
There is no further payout in my...
Excuse me, sir. Sir, your voice is breaking. Could you please repeat?
Okay. Is this better?
Yes, sir. This is much better.
Okay. Yeah. So what I was saying was that, as has been clarified earlier, that the tech agreement, the agreement is basically a formalization of the working arrangement that we have, and there is no impact in any way, shape, or form on the on our P&L as a result of this. In terms of localization, what we have localized, as per the government regulations, what we have localized is the maximum we can do with the current supply chain available. So for a given model, if you take model A, just take any model that we have. If you take model A, we have localized it to the best of our, to whatever we can do today in India. There is no possibility to localize further than that as of now. However, as we are progressing, we are adding more and more models. So currently, there are 2 families that are localized, and these have several models within them. The third one is coming on stream. Will be localized by towards the end of the coming quarter, towards we're in July also. Yeah, towards in the early part of the third quarter, and the fourth family will be localized in the fourth quarter. So and again, in each of those cases, when we localize, we will localize pretty much everything that we can technically localize in India, and then we have to wait for maybe someone to set up a plant to make electronic components or to improve the capability of PCB manufacturing in India, and only then will we be able to localize further.
Okay, and just one more question on this. Post this new AI standards, any perspective you can give in terms of the competition landscape for MCU? So, if we look at the marketplace right now in last 2-3 years, we've seen a lot of other players, have no background per se, either in electronics or related components, have entered the space for MCU, motors, and others. So, post this stringency in terms of the standards, what is the feedback you're getting from your customers, and what is the sense on the competition landscape?
So, despite, the announcements may be many, but if you actually look at who's got any volume in the market, those will be a handful of companies. It would be us. It would be Brose. Brose is also very small right now. It would be Mahle. It would be Hella. And Bosch and Brose would be small. That's where the volume is divided. And there's probably one Indian company that's doing some volume. So that's where the volume is divided across the entire two-wheeler and three-wheeler landscape. I'll address the LCV landscape separately. People are announcing. I guess they're putting in the efforts. I think we'll have to see how this pans out. We'll have to see which ones have made the right investments in capability, not only technical but also in building up the ecosystem and building up the supply chain, and we'll see that.
we've talked about the growth rate expectations in the industry are over the next 5-7 years are pretty close to 50% a year CAGR. So there is a lot of scope for companies to participate and play in this market. We believe that we'll be able to grow. We will be able to maintain a strong position in this segment because of the investments that we have made in all aspects of our business. So I can't comment on whether company A or B will be successful or not, because we'll have to just see how they actually perform on the promise that they make.
And the agreement with the Chinese partner, does that restrict us in terms of capitalizing any export opportunity, if at all that's a focus area?
No, actually, we participated in our first overseas trade show earlier this year. It was in Southeast Asia. I think it was more to learn the market. I don't expect to report export numbers in the near future, but or I'll say not to report any significant export numbers in the near future. But we have the ability to sell to certain markets, unilaterally, and others on an agreement. So I mean, we've received inquiries from, say, Germany, and we've from a two-wheeler company, and we agreed with our partners that we would handle it because we were better equipped to handle it. We didn't get the business; it was too complex a transaction, but there's nothing that stops us from talking, and then we are very open about these opportunities and we discuss them.
Okay, but more complex or product technology or
product technology, logistics. How do we? Our concern was how do we support? The big strength that we have in India is that we have a tremendous amount of technical support available. So we can resolve problems, manage vehicle integration issues, etc. Managing that in Germany was too expensive for the kind of volumes. Meeting German standards, giving the support required, etc. Was just not viable for us. But these are all. I mean, these are opportunistic. There's no. We don't have a plan to export to, say, Germany. If someone has given us an inquiry, we've looked at it. Like I said, I don't expect to see exports in the near future. It's not. We've got our hands full with the Indian market. The direct answer that I would give is that we are able to export to other markets, but it's not something which is a priority for us at this time.
Thank you. Participants, you may press star and 1 to ask questions. We'll take the next question from the line of Karthi from Suyash Advisors. Please go ahead.
Yeah, good morning, sir. A couple of clarifications. One is in terms of the understanding with GTEC. Given that the local supply chain will evolve over a period of time, are you also planning to pencil in some kind of transition path for a higher percentage of local content? And I'm asking this because there will be a compromise on their interest in this context.
Look, again, there are no, as of today, over the next 1 or 2 years, we don't expect to be able to source any electronic components in India. There is no supply chain available. DSPs are not made in India. MOSFETs are not made in India. Current sensors are not made in India. So there's no value to trying to source locally.
Sure.
Okay. So if we have to buy a DSP, the DSP is from a company. Would be from the global companies. It's from a Renaissance or a TI or a ST or someone else. These are global giants in this field. So none of them have a manufacturing facility in India. All of you follow the news articles on Foxconn and other ventures, and you understand the lead time and the gestation for something like this. And you have to understand that even if there is no silver, there is no magic wand that anyone has on building an ecosystem for electronic components in India. This is something which will take a lot of effort and a lot of time. If let us assume that someone goes ahead with a microprocessor plant in the country in the near future, it'll probably take 2 years to build, 2 years to stabilize. Sure. Okay, that's if they broke ground today. I'm not an expert on on semiconductors, so please don't take my numbers or my timelines to be right. But I'm just giving you an indicator. So let's say easily 2 years to build, easily 2 years to stabilize. And then the question is, if someone was putting up a plant to build microprocessor to do wafers in India or to do a fab plant in India, would you first put up a plant to do? Would you first focus on power electronic components like what is used in EVs, or would you first focus on, let's say, mobile phones or TVs? Yeah. At least if I was taking that business decision, I would focus only on mobile phones. Sure. So, and that's a different thing. So, there's a lot of talk about this, but we have to then sift through layers of information and understand exactly what's being talked about. Definitely, we are moving in the right direction as a country, but we are playing catch up, and we are years away from building a viable electronic component ecosystem in India.
Fair. But am I to infer, therefore, that the agreement you'd sign would be for a relatively short term, say for 5 years, or do you believe that you're looking at an open-ended agreement to be renewed on a progressive basis? Sorry? Are you looking at an open-ended agreement or a perpetual kind of an agreement, or a time-bound kind of an agreement?
Agreements can't be perpetual, so it is a time-bound agreement. But again, we have the option to revalidate it. We'll see how the market evolves and then take a call from there.
Fair. The second question, sir, was you spoke about two families currently, commercialized, and 2 more by the end of this year. Would any of these 4 families include a proprietary model, or all 4 are based on what's been sourced from GTEC's inputs?
All 4 are based on technology from GTEC.
Right. And when would your own proprietary model be available for commercialization, sir? Your best case is in advance.
I assume that by the end of the FY25.
Interesting. Sure. Thanks for answering my questions, and very best wishes, sir.
Thank you.
Thank you. The next question is from the line of Piyush Parag from Nuvama Wealth. Please go ahead.
Good morning, sir, and congratulations for the good numbers. One question, sir, I'm again pushing on the localization. So just wanted to understand what percentage would be kind of your localization would be currently? And if I assume nothing new infrastructure is developing in EV, so what kind of localization in percentage we can go up? I mean, just for the purpose of to understand it, not very specific, but if you can make some sense on this.
The import content is between 50 and 60%.
Okay.
And I'll say that is consistent within, and this is what FAME 2 requires right now. I think FAME 2 looks at a couple of things. They look at the total import content, or they look at the number that you asked for. They also look at they allow you to import about 20% of components that could be manufactured in India. You can import, citing technical reasons or other things. But at least 80% of all components that can be made in India have to be bought from India. So they look at a couple of different filters for this. All the companies that are doing this right now are in the same ballpark. There may be 5% difference here or there, but it's all in the same ballpark.
Okay. Yeah.
Because like I said, again, it's the key components are not made here. I mean, the biggest value are driven by 3 or 4 types of components, and those are not built in India.
Okay. Thank you, sir. Yeah.
Thank you. Participants who wishes to ask questions may press star and 1 now. You may press star and 1 to ask a question. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Atul Agarwal for closing comments. Over to you, sir.
Thank you, everybody, for giving us your time and being patient with us today. We are always available. SGA and our investor relation partner, you can always reach out to them and set up calls us, and we'd be happy to provide additional information. Thank you. Have a good day. Thank you very much.
Thank you very much. Ladies and gentlemen, on behalf of Sterling Tools Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.